Welcome to Metal Market News. This is Professor Harry, your independent analyst, where we break down the noise and decode the real signals in the precious metals market. And today we are looking at a critical question that every serious investor should be asking right now. Are we at the end of the bull run in gold and silver, or are we still in the early innings of something much bigger? Because what we are witnessing right now is not just price movement, but a shift in sentiment, structure, and long-term positioning. And when we analyze the discussion around whether the January rally marked the peak of the cycle, we have to understand that market cycles rarely end in a single explosive move. Instead, they tend to unfold in waves of enthusiasm, correction, consolidation, and then renewed momentum. And from a high-level analytical standpoint, the idea that the bull run is over simply because we saw a strong rally earlier is not supported by historical precedent. In fact, most major bull markets and commodities experience multiple phases of euphoria before reaching their ultimate peak. Now, when we look at the argument presented that it may take a move toward $150 silver to bring back the same level of crowd enthusiasm that we saw at $100, this is actually a very insightful observation because it reflects a key principle of market psychology, balance, which is that investors become conditioned by past price action. And once they experience a sharp correction, their future behavior becomes more cautious. And from my perspective, I agree with this assessment to a large extent, because we have seen time and time again that after a major pullback, retail participation does not immediately return with the same intensity. However, where I add nuance is in recognizing that institutional capital behaves differently. Because while retail investors may hesitate, institutional players often use these periods of hesitation to accumulate positions at more favorable prices. So while the crowd may not rush back in immediately, the underlying demand can still remain strong. And this is why I believe that the bull run is not only intact, but potentially still in its expansion phase, albeit with a different participation profile compared to the initial surge. Now, when we incorporate the broader market context, including the behavior of physical demand and dealer activity, this adds another layer of confirmation to the bullish thesis, because the observation that gold is selling faster than silver in many retail environments is not just anecdotal but indicative of a shift in investor preference toward higher value, lower volume assets, particularly among those with greater purchasing power. And this aligns with what we typically see in the mid to late stages of a bull market, where more capital flows into gold as a store of value, while silver begins to lag temporarily due to its dual role as both an industrial and monetary metal. However, I would challenge the assumption that this trend necessarily signals weakness in silver, because historically silver has a tendency to lag behind gold during the early and middle phases of a rally, and then outperform dramatically in the later stages. So what may appear as underperformance today could actually be a setup for a more explosive move in the future. And this is where a disciplined analytical approach becomes essential, because reacting to short-term divergence without understanding the underlying dynamics can lead to premature conclusions. Now, shifting our focus to the broader retail and dealer environment, the insights shared regarding inventory shortages, rapid turnover of products like buffalo rounds, and the inability to keep gold in stock are extremely important indicators of real-world demand, because unlike paper markets, physical markets reflect actual buying behavior. And when we see products moving as quickly as they are being stocked, this suggests that demand remains robust despite higher prices. And from my perspective, this is one of the strongest arguments against the idea that the bull run is over, because true market tops are typically characterized by oversupply and declining demand, not by shortages and rapid sales. However, I also want to highlight a potential risk here, which is that strong retail demand can sometimes be driven by fear of missing out rather than fundamental conviction. And when that happens, it can lead to short-term spikes followed by corrections. So while the current demand environment is supportive of higher prices, it must be analyzed in conjunction with broader macroeconomic factors to determine its sustainability. Now, when we examine the discussion around entry-level investors and the accessibility of silver compared to gold, This is where we see a very important structural dynamic at play. Because silver continues to serve as the gateway metal for new participants, allowing individuals to start building positions with relatively small amounts of capital. And this is a critical component of long-term market growth, because today's small buyers can become tomorrow's large investors. And from a strategic standpoint, this creates a steady pipeline of demand that can support prices over time. However, I also want to point out that the increasing price of silver relative to historical levels may gradually reduce its accessibility, which could slow the rate of new participant entry. And this is where fractional products and alternative forms of silver ownership may become increasingly important. Now, as we move into the discussion around refining capacity and market liquidity, this is another area that provides valuable insight into the health of the market. Because the normalization of refinery operations and the resumption of buying activity for scrap silver and junk silver indicate that supply chains are stabilizing. And this is generally a positive development, as it enhances liquidity and allows for more efficient price discovery. However, there is also a potential downside, which is that increased liquidity can lead to higher supply entering the market, potentially putting downward pressure on prices in the short term. And this is where I partially diverge from the optimistic narrative. Because while improved liquidity is beneficial for market functioning, it does not automatically translate into higher prices. And in fact, if supply increases faster than demand, it can create temporary headwinds. So this is an area that requires careful monitoring rather than blind optimism. Now turning our attention to one of the more fascinating aspects of the discussion, which is the role of errors and anomalies in the coin market, such as the reported case of silver coins being struck without silver content by the Royal Mint. This highlights an entirely different dimension of the precious metals market, which is the intersection between bullion and numismatics. And from an analytical perspective, these kinds of errors are not just curiosities, but can become highly valuable assets due to their rarity and uniqueness. And this underscores the importance of understanding that the value of coins is not solely determined by their metal content, but also by factors such as rarity, historical significance, and collector demand. However, I would caution investors against conflating these niche opportunities with the broader bullion market. Because while error coins can generate significant returns, they represent a very specialized segment that requires expertise and careful evaluation, and therefore should not be considered a core investment strategy for most participants. Now, as we move toward a broader conclusion, it is important to address the concept of market psychology and how it influences investor behavior at different stages of the cycle. Because the idea that it may take significantly higher prices to reignite the same level of enthusiasm seen in previous rallies is rooted in the psychological impact of volatility. And from my perspective, this is a valid observation, because investors tend to anchor their expectations to past experiences, and after witnessing a sharp rise followed by a correction, they become more cautious and selective in their decision-making. However, this does not mean that the bull run is over. Rather, it suggests that the market is transitioning into a more mature phase where participation becomes more measured and strategic. And in my analysis, this is actually a healthy development. Because it reduces the likelihood of speculative excess and creates a more stable foundation for sustained growth. And when I compare this with a broader analyst narrative, I find strong alignment in the recognition that the bull run remains intact. But I also emphasize the importance of understanding the evolving nature of that bull run, because it is no longer driven purely by hype and momentum, but increasingly by fundamentals, structural demand, and long-term positioning. And this shift has significant implications for how investors should approach the market, because strategies that work during the initial surge may not be as effective in the current environment, and therefore adaptability becomes key. And in conclusion, while the question of whether the bull run is over is both valid and important, the evidence suggests that we are not at the end, but rather in the middle of a complex and evolving cycle, where opportunities still exist, but require a more nuanced and disciplined approach. And as always, Staying informed, maintaining perspective, and focusing on long-term fundamentals will be the most reliable path to success in the precious metals market.